Hey everybody, welcome to my channel. Hope you guys are all doing well today. This is the agenda for today's video. And if you guys wanted to hop around to parts of the video you guys find most relevant, timestamps are in the description below. I just want to start this video off by saying that Thorchain is perhaps one of my most favorite projects in the crypto space. Full disclosure, I do have a position in Rune. And if you're interested on real-time insights, maybe you're interested in my price predictions for Rune, I encourage you guys to check out my Discord channel by clicking the link in the description below. It's a great forum for you guys to connect with like-minded individuals, share ideas, insights, potential trades that you're making, and you guys will find me routinely checking in and engaging with the community. Also, consider checking out my newsletter. I give you guys industry highlights, token picks, and if you're a big fan, I also give you guys a summary of all the content that I publish on a weekly basis. So if you're interested in DeFi news, you want insights on market trajectory, and you want to know what portfolio changes I'm making, just click the newsletter link in the description below, enter your email address, and you guys will be all set up for my free newsletter. With that out of the way, let's go ahead and dive into this video. Alright, to kickstart this video, let me give you guys a quick background and introduction on the Thorchain project. If you want to break it down to its basics, it's really a decentralized exchange like Hyper, Uniswap, or SushiSwap. By the way, if you guys wanted to learn more about SushiSwap, make sure to watch my past video on it. And the Thorchain team describes the protocol as a decentralized liquidity network. Essentially what they're trying to say is that Thorchain is a protocol that's highly composable. It's like a Lego piece that can be integrated on the back end of exchanges, that can be integrated into wallets. Heck, you can even have an integration with Ledger. They'll provide their own UI so you can trade assets, you can stake, and people can even set up arbitrage bots. And one key way that Thorchain differentiates itself from other decentralized exchange projects by encouraging desired actions from market participants through very robust incentives. Just to illustrate the point, within the first year, the liquidity providers are projected to make upwards of a 40% yield on their assets. So to really boil it down, you can think of Thorchain as a combination of BlockFi and a decentralized exchange. Assuming that they achieve desired metrics, you're going to earn a much higher yield than BlockFi, but you're also going to be paying less fees than other decentralized exchanges. In this network that they're creating, there's going to be 4 market participants, the liquidity providers that put their assets into the pool and that are given a yield in return. And since you're going to be able to trade assets, there's going to be arbitrage opportunities. So you're going to definitely have arbiters who are going to be participating in this ecosystem. You'll also have node operators. To become one of these node operators, you have to have 1 million Rune. They're going to be responsible for validating transactions, securing the network, and they're also responsible for updating their software when there's an upgrade implemented. This perhaps is the most important role, and it requires a lot of due diligence and activity on the node operator's end. And as a result, their rewards are going to be much larger. You could also look at the node operator as an exchange because they're essentially going to be performing the same functions. And lastly, you have what they call swappers, which is basically traders that are going to come on the platform and exchange assets. Unlike Uniswap, which has a fixed fee model, Thorchain is going to implement a slip-based model. So the bigger the slippage you cause, the bigger your fee is going to be. And based on their projections using this model, stakers, people who provide liquidity, are going to get larger rewards. Now, before I shift over to the next segment of the video, I wanted to quickly go over this liquidity black hole theory. I'm not sure who came up with it originally, but I'm going to go ahead and give credit to Andrew Kang. But based on this theory, Andrew Kang and myself believe that there's a good chance that AMMs like Bancor and Rune Chain will pull liquidity from centralized exchanges, decentralized exchanges, and cold storage. To break it down, let's quickly go over the liquidity begets liquidity feedback loop. So Bancor and Rune have methods to bootstrap liquidity. They're going to provide increased incentives to early liquidity providers. So that's basically a way to bootstrap liquidity. When you have more liquidity, you get less slippage and tighter spreads. As a result, you get better prices for traders. Then you'll see more traders come onto the platform to execute trades. But not only that, you also have aggregators like 1inch. If the fees and the prices are better on one platform, they'll route orders to that exchange. As the volume increases, so is the yield. So everybody that's already providing liquidity, their yields are going to go up. And as those yields go up, more liquidity providers are going to come in to add liquidity. Now, the way Rune and Bancor pools work is that one side of the pool will have Rune or Bancor tokens. The other side of the pool will have another token that people want to trade out of. So for example, one side will have Rune tokens, the other side will have Link tokens. That also means if one side of the pool has $1 million worth of Link tokens, the other side of the pool needs to have $1 million of Rune tokens. So as market participants come in to provide liquidity, the demand for Rune and BNT will go up, and therefore their respective prices will go up as well. And the reason why Kang thinks this is a feedback loop on steroids is because as BNT and Rune increase in price, so will the overall yield in that pool. And as that yield goes up, more and more people are going to be incentivized to provide liquidity into that pool. And to further sweeten the deal, when people anticipate a large BNT Rune LP yield, they're going to buy more, therefore increasing the price, creating a self-fulfilling prophecy. In Kang's opinion, this is why Synthetics did a mind-blowing 50x over 9 months. And just to end this segment, the reason why I slightly like Rune better than BNT, because number one, it's chain agnostic, and number two, unlike BNT where the ratio between total value locked and BNT is 1-to-1, with Rune it's going to be 1-to-3. This means every $1 of an external asset locked into the pool, there's going to have to be $3 worth of Rune tokens added to the network. One of those $3 is going to be added to the other side of the pool. Two of the $3 have to be bonded to the nodes. Now we're going to go ahead and transition over to talking about the tokenomics. But before we dive into that, I think it's important to give you guys a bird's eye view of the mechanics. This way you know what the actors are responsible for and how the funds are being moved around. So the reason Thorchain is able to do cross-chain trades is because they don't actually store the tokens in one location. What they basically have is multiple vaults, and the nodes that are securing the network, they look out for signals, and when enough of them confirm a signal, tokens are moved. To demonstrate how this works, I'm going to go ahead and go over the flow using this visual. So you have an incoming transaction. The nodes have to confirm this signal that's coming in. Once it's confirmed, they'll go ahead and parse the data, meaning they'll figure out who the user is, where the funds are coming from, where they're going, how much, gas fees, etc. And if the intention is to trade the assets, then a swap logic will be activated. The nodes will confirm all this and a signal will be emitted externally, validating the transaction on the external blockchain. That leads to the token that's desired by the user going out to his wallet. To simply put it, you basically have one signal coming in from an external blockchain into Thorchain, that being the deposit. The token goes into a vault. This will initiate Thorchain to send its own signal out to be broadcasted to the target blockchain, in this case being the token that the user wants to receive. This way there's no need to commingle assets and users are able to trade assets that belong to different chains. And the reason why this is relevant to the tokenomics is because to do all this you need to have stakers and you need to have nodes. As I mentioned in the intro, each pool has to have a 1-to-1 ratio, meaning $1 million worth of Link on one side of the pool, $1 million worth of Rune on the other side of the pool. And for the nodes, for every $1 million worth of Link locked into the pools, there needs to be $2 million worth of Rune bonded to the node. In other words, when it comes to the total value locked into the Rune protocol, you need to have a 3-to-1 ratio between Rune and the external asset. And it's also important that nodes have 67% of the Rune and the stakers have 33% of the Rune. This is going to be enforced through something called an incentive pendulum. We aren't going to go over it in this video, but if you guys wanted to learn more, make sure you guys express that in the comment section below. But the key takeaway here is that as you get more external assets locked into the protocol, that's going to increase the demand for Rune tokens, therefore increasing its price. In theory, this could produce a sustainable demand for Rune tokens. If you've been in the space for a while, you've probably heard of the bonding curve. It's basically a way to distribute tokens over a prolonged period of time. So with this, you could argue that it's going to dilute the supply, but they're not going to do this abrupt. The current plan is to use the the 220 million Rune token reserve and slowly disseminate that to nodes and liquidity providers over a 10-year period. And every year, the token amount that they actually give out to nodes and stakers is going to progressively diminish over time. And this makes sense because if the network does grow and therefore the token price goes up, they'll be able to sustain the yield somewhat, because even though they're giving out less tokens, every year those tokens are going to be worth more and more. Also, you do want to bootstrap liquidity, so you want to give it to people that are early adopters, because this is a group that's going to potentially kickstart that feedback loop and potentially create a liquidity black hole. Now let's shift over to talk about distribution. This is important, especially if you're an investor. You want to know who's holding most of the tokens, what the circulating supply is. And before we talk about the distribution, on a side note, I highly recommend that you guys subscribe to their Medium profile. They publish regular reports on development updates, monthly treasury reports, and they even give you updates on distribution, which we'll be talking about now. So the current distribution looks like this. You have 20% that went to the public DEX IDO. You have another 12% that went to the staking program. And if you guys wanted to participate in that, make sure you guys watch my most recent video on Thorchain. You have 12% that went to operational expenses. You have 10% that was allocated to the team, and you have 5% that went out in the original seed sale. And unlike other teams and projects which raise hundreds of millions of dollars in their ICO but haven't delivered a product, they raised about $3 million. And at the time of recording, they're basically live with their mainnet. Currently, there's over 5,600 Rune token holders, and the token distribution amongst these holders is highly concentrated, where top 100 holders have about 64% of the total circulating supply. Now, to be fair to the team, many projects, even Bitcoin, started off being highly concentrated, but as we go through these bull and bear markets, the token becomes more and more distributed. Also, as a token price appreciates, I'm sure many of the whales will sell a portion of their tokens to be staked into the pool. For example, when the token hits one of my price targets, I plan on selling out a portion of it into BUSD. This way I can use my BUSD and Rune to stake into a pool and earn passive income. Another reason why I'm not overly concerned about token concentration is because about less than 10% of the circulating supply is on exchanges. If there's enough demand, the token price will move pretty fast, in my opinion. And lastly, there's only a handful of nodes that are currently operational. Once they bring in more market participants into the network and they start running their nodes, you're inevitably going to see the token demand increase, because as I stated earlier in my video, you need at least 1 million Rune tokens to set up a node. In terms of what to look forward to, once they've connected to Binance Chain and they've determined that the network is stable, they'll begin moving over to the next stage where they test Ethereum integration. At that point, they'll do this closed testnet. Once that's successful, they'll open it up to the public. They'll begin adding ERC20 assets. And after all that, you'll see Bitcoin added. What I'm really looking forward to is Ethereum being added, because they entered this partnership with Synthetics. Once they're able to integrate ERC20 tokens, Synthetics is probably going to be one of the first few tokens that's added. And currently Synthetics is working on making synthetic stocks. This way people can get exposure to Apple, to Tesla. What I suspect will happen is that they'll create pools for these stocks. So in essence, you can get exposure to Tesla via the Synthetics. You could put it in the Thorchain pool and earn passive income on your synthetic stocks. They also have plans for marketing and integrating this protocol into other platforms. For example, you can integrate this into an exchange. In fact, you can even take out the entire back end of an exchange and replace it with Thorchain. We've also talked about wallet integrations and integration into Ledger. And to incentivize these guys to integrate the Thorchain protocol, they're actually devising a referral scheme. This way, platforms that integrate Thorchain can get a piece of the action from the volume that they help generate. And since this is a protocol that anybody can build on top of, you could get platforms that use the protocol for liquidity, and using their own internal mechanisms, they could provide lending, margin trading, and even indexes. A lot of cool updates are coming, and if you guys wanted to keep up with them, make sure you guys follow me on Twitter. Like any other project, there are some shortcomings. For one, this is a novel design. There's no guarantee that this is going to work. They've done an assessment with a third party, and that party determined that the network will most likely be stable. But just because something works in theory, that doesn't mean it's going to work in the wild. Also, back in 2019, they wrote a piece stating that their platform will remove a permanent loss. They later had to revise that. It doesn't look like it'll completely remove impermanent loss, but they suspect the most you'll lose due to impermanent loss is about 10%. But that might discourage some people from participating as a liquidity provider. I'm confident that the prospects of impermanent loss will dissuade a lot of people from participating as liquidity providers. So their best hope is that with the incentives that they're providing and the yield that they're providing, that it offsets any impermanent loss that the user may be subject to. Another problem is that you have to also get exposure to Rune if you want to be a liquidity provider. Bancor, on the other hand, came up with a model where you just have to provide liquidity with one asset and not two. For example, let's say you own Link tokens and you're a Link bull and you don't want to buy any other token. Well, if you want to be a liquidity provider on Thorchain, you're going to have to get some Rune tokens. In my view, this is another barrier for liquidity providers. Another problem the project may have is the fact that the token distribution is heavily concentrated. When investors find out about this, it may discourage them from investing or buying Rune tokens. And even though it's technically a decentralized platform, if a few people or a few parties are guiding the direction of the protocol, I would characterize that as being somewhat centralized. And this leads me to the next problem. Unlike other projects that implement a DAO, their plan is to minimize governance. And the rationale for doing this is to limit the opportunities for nodes to collude. But I personally would like more details. If you look at the documentation online, they don't really provide a lot of details on exactly how the process for updating the protocol is going to look like. Personally, I prefer the DAO model just because it gives token holders a vote based on the number of tokens that they hold. I'll concede that the tokens are also highly concentrated in those projects, but as tokens become more distributed over time, the entire process is going to become a lot more democratic. Now, to conclude this video, let's go ahead and talk about how I feel about the project and where I see it going. To begin with, I love the fact that it's an open source protocol, meaning that it's highly composable. It's basically like a Lego piece. I can already think about a lot of use cases for the protocol. And this is important from a long-term investment standpoint. The protocol needs to be able to achieve a certain level of ubiquity, meaning that there needs to be a good chance that a lot of different platforms are going to want to integrate it. It's much like Link. I personally decided to invest in Link tokens when it was trading around $1 to $3 because I had a strong feeling due to its network effects, the technology that they were producing, that there was a possibility that it was going to be the standard for the entire industry. And to date, you've seen a lot of integrations of the Chainlink Oracle. Despite some of the shortcomings I mentioned to you guys in the previous segment, I think there's a good chance that Thorchain is going to be integrated across a wide variety of different DeFi protocols and eventually even on platforms outside the DeFi space. And one thing that helps projects go viral is a very generous referral program. Why would an exchange want to integrate this protocol if they're not going to be able to make any money off of it? This is where the fee model would come in. I'm sure they're going to find a way to make sure that the exchanges are well compensated for integrating this protocol. Moreover, these exchanges can get more involved and extract even more value by setting up their own nodes. And since they already have large user bases, they can integrate the protocol into their platform and make it easy for users who have their funds deposited on the exchange to easily put them into the pool. And on top of that, they can even deploy their own bots for arbitrage opportunities. So just to summarize that, the exchanges could set up a node. They can also generate revenue through a referral schema. They can make it easier for their users to stake their tokens. And by offering that service to them, they could take a little bit off the top. And on top of all of that, there's even opportunity for arbitrage. Something else that makes me pretty excited is the fact that they haven't even begun to market the platform. Once they start marketing the platform, they create awareness, assuming that they achieve their objectives. I could see this protocol gaining adoption rather quickly. Another thing that they have going for them is gamification. They've done a really good job of encouraging desired behavior by market participants through incentives. The incentive pendulum is a perfect example of this. There has to be twice as many Rune tokens bonded to nodes than there are Rune tokens in the liquidity pools. By raising and dropping the yields, the hope is that the market participants, by providing or not providing liquidity, will maintain that ratio. You guys can also check out Thorchain by going to their website, clicking on View Testnet. Right now, they're only going to be supporting Binance Chain coins. And the way it works is that they're going to be adding one new coin per day. Anybody can add a pool, but only the pool with the largest amount of liquidity is going to go live. And right now, because they're doing a lot of testing, you may not be able to access your wallet. Even though you can't see the APYs here, The APY for Binance Coin was about 90%. I was able to participate in that until they recently closed the cap. And at the top here, you can see that they've staked a total of 740,000 and they've earned over 60,000 in rewards with just being live for a few days. And when it comes to taking profit on my Rune tokens, what I plan to do is basically sell some of it into BUSD and just stake it here on Thorchain. This way I can lock in profits by selling some of my Rune tokens and also earn interest on my cash position. Now, after watching this video, if you enjoyed my nuanced perspectives and you're interested in getting one-on-one dialogue with me, consider checking out my Patreon page. You'll get Substack access, you'll get access to my private Discord where we talk trading strategies, we talk about various tokens that we're investing in, and I have a lot more services that I'm going to be adding in the pipeline. So if any of those services interest you, I highly recommend checking out my Patreon page by clicking the link in the description below. With that being said, this is CryptoOneStop signing out. I'll talk to you folks next time. Bye.